Welcome to the video on financial intermediaries. I think one of the more important sections of this initial learning module within equity investments. In this video, we're going to define the role and function of intermediaries like brokers, dealers. We'll talk about the role of investment banks, how an exchange kind of works a little bit, and why we also have trading happening within so-called alternative trading systems. And later on, we'll also discuss the role played by so-called arbitrageurs. Now, if this is your first encounter with the Let Me Explain channel, and if you like the video, I recommend you subscribe to it and maybe even consider becoming a supporting member to get full access to all the videos that are available. Right, let's get cracking. The intermediaries that you need to know about, first of all, are brokers. So, who is a broker? It's very important that you're able to distinguish brokers from dealers, although they very often function under one roof. What brokers do is they fill client orders. So think about an order as a client's wish to buy or sell some securities, for example. So they fill client orders, but do not trade with the clients themselves, but do not trade with the clients. So basically their job is to search for the other side of the trade, and they perform a kind of matching function. They bring clients together for which they earn a fee typically. So let's say this is somebody who wants to buy, a buyer, and over here is somebody who wants to sell, a seller. A broker is the one who will, arrange the transaction to happen between them. This is money changing hands, and that's, for example, securities, shares or bonds going this way, and the broker will collect a fee from one or the other or both for their services in matching the two sides. Now they can do this, sort of personally over the phone, let's say, or in person. Or typically we operate various types of matching systems that get buyers and sellers connected. That's how brokerage works these days, more or less. Now, a special type of broker is going to be someone described as a block broker. So this is a broker who specializes in handling large trades. So a broker to large clients like asset managers, right? Investment funds who need to buy or sell big loads. Now these big quantities or large orders are actually quite hard to fill. Large orders are hard to fill. And that's a fact of life, because if you want to buy a lot, you'll typically have to pay a bit of a premium, or quite a substantial premium to get the amount you need of securities relative to what you observe as the price in the market. But that price in the market is typically for, smaller transactions. And when you're selling, and if you want to offload a big chunk of shares or bonds, once again you probably need to accept that you'll do it at a bit of a discount. Now hiring a block broker allows you to potentially, depending on the skills of the broker and the situation in the market, minimize that effect, that premium or discount. But one of the things that a large block broker will do is they will try to make sure that knowledge about your transaction doesn't become public, because if it does, if people recognize the fact that there's a big buyer or a big seller who's entered the market, typically the price will run away in a direction which is unfavorable for you. And we'll talk about that in just a moment when I show you the functions of the exchange versus what happens in an alternative trading system organized as a dark book. Okay, now the next very special type of intermediary are investment banks. Now, lots of people have the wrong impression of what investment banks do, because they think, well, investment banks primarily invest. And that is, well, on the one hand, that is not perfectly correct, although it has to be said that most of the world's big investment banks these days also do trading as a sort of extra activity, which has actually become their dominant activity. So there's a bit of truth in that. However, pure sort of core investment banking is all about two things: providing advice, especially when it comes to mergers and acquisitions transactions. So you're basically advising corporate clients on deals and the way to structure them, and you're advising either the buyer or the seller, in a transaction. But there's also another component here that is helping arrange debt and equity issues. So whenever your corporate clients typically want to issue shares or bonds, they will hire an investment bank to sort of help them structure the whole process and actually help them primarily identify buyers, investors with whom they will be matched via the investment banks. And later on in the video series in this learning module, we'll have videos on primary markets, so how debt and primarily equities get issued with the help of investment banks. Let me just show you, the website of one of the world's biggest investment banks, biggest players in this field. That's going to be Goldman Sachs, although not this website, this one more precisely. Over here, I've gone into what we do, our businesses, and look, under the section Global Banking and Markets, they talk about, on the one hand, investment banking, and on the other hand, something called FIC and equities. FIC and equities is fixed income, currencies, and commodities. That's the abbreviation. FIC. Equities is, of course, the markets for shares, and this is them talking about the fact that they are present in the market as intermediaries, as brokers and dealers. We'll talk about dealers in just a moment. However, my focus now is going to be on investment banking. But look, mention of advisory services here, very prominent. Let me click on Read More, and after we've clicked on Read More and we scroll down a little bit here on this website, our services include, on the left-hand side, mergers and acquisitions. So basically providing advice to clients who are involved in these transactions. And on the right-hand side, you've got financing, partnering with clients to navigate let me push this up, partnering with clients to navigate the complexities of global capital markets. So whenever clients want to get access to capital, typically by issuing equity or debt instruments to the capital market, you will hire somebody like Goldman Sachs, this is just an example, to help you with that whole process. So this is what investment banks do, but these days they also get involved. I mean, those same companies do get involved in being brokers and dealers in markets, so more actively involved in trading. Right, the next category of intermediary are exchanges, which is where typically traditionally buyers meet sellers, or that was the case for ages, right? They were organized as floors on which buyers met sellers and arranged trades. These days it's pretty much all electronic, but at the end of the day, an exchange is pretty much just a broker, in the sense that it's sometimes very difficult to distinguish an exchange from a broker, because it provides matching services. It matches orders received from buyers and sellers to buy and sell shares, and it uses, these days, an electronic system to match those buyers and sellers. Although it does also perform some additional regulatory functions typically. So And this is where the difference really comes between exchanges and other types of brokers. So Plus perform regulatory functions. So, for example, they regulate the behavior of their participants, of the members of the exchange. Plus, very often, they also regulate the issuers of instruments that trade on the exchange. So if somebody wants to have their shares trading on a recognized public market like the New York Stock Exchange, on the London Stock Exchange, they have to conform with certain rules that those exchanges set with regard to disclosure of information, the publishing of regular financial info like quarterly financial statements, updating relevant current information about the company whenever something significant is happening, etc. There may also be exchange-based rules regarding prohibition on too much concentration happening in the shares of a company, so that there isn't a single owner who dominates above others, stuff like that. And exchanges are typically regulated themselves by appropriate sort of national authorities, like the Securities and Exchange Commission in the United States, the so-called SEC. Now, similar to exchanges, we these days have alternative trading systems, ATSs. And as I say, they are absolutely similar to an exchange, the alternative trading system, but they're not the same as an exchange. Other names for these are MTFs. This is especially the name that's going to be popular in Europe, in the European Union, actually in Europe, which stands for multilateral trading facilities, and but also ECNs, electronic communication networks. Now, they behave like exchanges in the sense that they're a venue, they are going to be an electronic venue where buyers and sellers can be matched with their orders to buy or sell. But one of the features that they offer is, on top of being like a normal exchange, is that they also operate so-called dark pools. And dark pools are special trading systems which are not transparent. They do not display the orders received. Why? I'll show you in a moment. This is especially going to be valuable, or especially interesting, let's say useful, for large buyers and sellers, for large investment managers. Okay, so what I want to do now is go to a proper exchange. Over here I've had the website of Goldman Sachs. Now next to it I've got already opened the website of the Frankfurt Stock Exchange in Germany. So this is Börse Frankfurt, and you can see this on the screen, the page devoted to Deutsche Bank, one of Europe's largest financial institutions, and not just Europe's, the world's. And what I'm going to focus on is this table, which probably, as I speak, is going to update and flash, and flash in the sense of things changing in it as they are right now. Okay, this is the bid-ask overview. It's actually colloquially known as the central order book, and in fact, I mean, we'll talk about this later on when we discuss different order types, how these orders get matched. But I want you to appreciate the purpose of operating dark pools and why they are useful. So what I'll do is actually I'll do a screenshot of this live. So just take a copy of that page and let me paste it into my note. It's gone very big, but I'm just going to adjust the size here because I want to be able to naturally draw on it. Right, good. I think that's a good, let's say, view of the bid-ask overview. Okay, let's push it up a little bit. Can I do that? Okay, it's fine. This is good enough. Now, what the bid-ask overview, or the so-called central order book, is showing us are the orders received by the exchange, split on the left-hand side into orders to buy, and on the other hand, orders to sell. Obviously, shares of Deutsche Bank. That was where the table came from, and these are waiting orders. In both cases, the reason why they are waiting is that, you know, when you submit an order to an exchange, there is no guarantee that you'll actually trade. You're just showing your willingness either to buy shares or to sell shares or some other security, but the exchange doesn't guarantee that you will be able to trade. After all, that is a function of whether they are willing traders on the other side, buyers or sellers, right, depending on what you want to do. Now, I can see that at the moment from which this table comes, there were 2,538 shares waiting to be bought, where the buyers expressed an interest or a willingness to buy for a price of 16 euros 0.192. On top of, in addition to this, there were also 2,289 shares waiting to be bought for a price of 16.19 euros. And as we go down in this table, you see more and more shares that buyers have expressed an interest in buying at certain prices. On the right-hand side, we've got the waiting sellers, right? Sellers of 2,825 shares waiting to sell for a price of 16.20. That is currently the lowest price for which anybody wants to sell. All the subsequent prices are higher. And in the same vein, this is the highest price which buyers want to buy. The reason why they're waiting, like why these buyers are waiting, is because nobody has arrived and said, oh, I'm willing to sell for a price of 16.19. So this table kind of shows you the waiting room, the waiting line. Now, if you are a big buyer or seller, like a big investment fund, and you go to a broker, and you don't use the services of a specialist broker, a block broker, like we said, who's a specialist in handling big trades, you just get somebody to send your request to the exchange. Let's say you want to buy 100,000 shares of Deutsche Bank for 16.19 euros. I mean, this isn't how you place these orders, but let's just imagine that you did. That 100,000 share order would sort of enter the waiting list over here on the left-hand side, and all of a sudden, this number of shares waiting to be bought at this price level would increase from its current 2,289 to 102,000, and the scale, the size of this horizontal bar would just shoot up and crowd everything out. Everything else would be scaled down. Now, the problem is that exchanges are quite transparent in the sense of displaying what's in the waiting line. And that's good for market participants, but it's terrible if you're a big buyer or seller. Why? Because the mere or the simple appearance of your order over here is a very important signal to others, and they will act upon it. You see, all the buyers who are waiting below you, who are also, let's say that they also want to buy Deutsche Bank shares, they will sort of look up and they will see your order over here, And that will not make them happy because you want to buy a big bunch of shares, 100,000, and the price which you've offered is higher than their respective prices. And if they want to increase their likelihood of buying, they will have to update their orders, amend their orders to run in front of you. So what will typically happen is a big rush among the buyers on the left-hand side who will amend their orders and increase them. And of course the sellers can see this as well, and for them this will be great news if a big buyer has arrived, because it gives them an excuse to lift their price. Whenever sellers catch wind of the fact that a big buyer has arrived, they just update the prices. And it may so happen that in this waiting line, because others will jump ahead of you updating their orders, you will move down. The central order book is often known in jargon as the ladder, because you can move up or down in it depending on where your order sits relative to others in terms of its price level. And even before you've had an opportunity to trade, the price may run away from you, always in a direction that is unfavorable. That's what happens in the markets. Now, dark pools offer something very special, which is used by big fund managers. The possibility to trade in a system which also will accept the order, but it will not display it to other participants even, So that's the essence of dark. Even if you send a big order to a dark pool, others will not see it waiting and will not be able to act upon the information. And as an example, I've pulled up the website of, once again, Goldman Sachs, and its dark pool, its MTF, its alternative trading system, called Sigma X MTF. And they actually talk about here two different books. And by the way, you can trade lots of different instruments on the Goldman Sachs MTF. It functions like an exchange. One of the ways in which it is different is that a company cannot do an IPO on the Goldman Sachs market, so you can't launch shares into trading on the into public trading on an MTF, on an alternative market. You have to do it via sort of an official, proper, normal exchange. But once a company's shares are trading on an official exchange, like the Frankfurt market in Germany or the London market, there is no reason why Goldman Sachs or somebody else who runs one of these MTFs wouldn't say, from now on, you can trade these shares on my market as well. The market is just a venue where buyers and sellers can convene, and the venue just matches them and says, okay, you've bought, you've sold, congratulations, now pay me a fee. This is how exchanges make money, or trading venues make money. So look at this. There are two different books here. One is called the Periodic Auction Book. And actually, if you look at the description, what I just want you to realize is that it says that this is a lit, pre-trade, transparent market, meaning the orders are sort of visible for others to see. They are transparent and there's light shining on it. Whereas the dark book is the one we are sort of more interested in. This one is completely dark, with no pre-trade information about your order ever conveyed to other participants. And that's, useful for large investment managers who don't want others to see the scale of what they want to do, because that would move the price, probably. Okay, the next type of intermediary, a very important one, are dealers, who also get called market makers very often. And what do dealers do? I mean, I'm very, very insistent on you being able to differentiate between brokers and dealers. Let's go back to the definition of a broker just for a moment. A broker, we said, fills client orders but doesn't trade with the client. So they kind of stand over here. They're not in the transaction as such as a buyer or seller. They just connect buyers and sellers. A dealer is going to be very different, because dealers actually get involved. They fill client orders, But this time, by trading with those clients, by trading with the client. So, when a client wants to buy, the dealer will sell. When a client wants to sell, the dealer will buy. That's their job. So often they kind of stand in the middle. That's a dealer or market maker. Here are the sellers. Here are the buyers. And when a client wants to sell something, for example, bonds, government bonds, they can sell to the dealer and receive some money. If a client wants to buy those same bonds, they go to the dealer and pay some money, right? The effect is, overall, that the dealer does connect buyers and sellers, but not directly. They connect buyers and sellers, often who arrive in the market at different points in time. So if I'm a fund manager on the left-hand side here, and I want to get rid of some bonds which I've got in my portfolio, I'll go to a dealer who specializes in these bonds, and I'll sell to that dealer. And the dealer doesn't make me wait until they've got somebody on the other side who's willing to buy. No, they'll buy from me at any point in time and then kind of take the risk of having to find somebody who'll buy from them at a later point in time. Obviously, for this activity and the risk that they take, they have to make a profit. And the profit is made very specifically via the so-called bid-ask spread. Because when a dealer is buying something from a client, they pay a price known as the bid. But when the dealer is selling to another client, they receive or they ask a price known as the ask price. And normally, in order to make a profit, you buy cheaper than the price at which you sell. The difference is known as the spread. Obviously, in order to stay competitive, if there's more than one dealer trading in the same thing, you have to you can't make that spread too high, otherwise other dealers will be more competitive and attract the clients. But this is how the dealer makes a profit, from the bid-ask spread. And please appreciate that dealers provide liquidity in the market. Dealers provide absolutely that essential thing called liquidity, because they enable their clients, who are buyers and sellers of securities, currencies, whatever, commodities, to trade when they wish. Clients can trade when they want to, when they wish, without having to wait for somebody who's willing to take the other side of the trade to appear, because the dealer is always there, for which they obviously take that bid-ask spread, but it's much more efficient and effective than waiting for somebody to appear. Now, most dealers are at the same time also brokers, and actually vice versa as well. So very often they operate under two sort of functions in the market. That's why we collectively call them broker dealers. But please appreciate the difference in terms of the activity being performed. A broker doesn't enter the transaction as a buyer or seller. They connect buyers and sellers as long as those buyers and sellers are simultaneously there and want to trade at the same price. And this is what an exchange does. An exchange doesn't buy from you or doesn't sell to you. An exchange just facilitates a trade when there are buyers and sellers on hand. A broker is somebody who will just sell to you or buy from you at any point in time, irrespective of whether they've got somebody to sell to or buy from simultaneously. Now, if an institution, a financial institution, such as many banks actually are broker-dealers, so they operate as brokers or dealers. When they operate under these two guises, there is a very important to appreciate conflict of interest there, right? Because if you are acting as a broker, so let's say you've been hired by somebody who's a buyer who wants to buy shares or wants to buy bonds. Your job is to locate a seller who will accept, the best a price that's best for your client, whoever has hired you. So if you're acting as a broker, your job is to seek the best price for your client. And depending on whether your client wants to buy, you should find them somebody who wants to sell at the lowest price. If your client wants to sell, well, find somebody who can pay them the highest price, right? Price for client. On the other hand, if you are acting as a financial institution, as a dealer, well, that's a completely different story, because you'll probably want to maximize your profit from standing in the middle. So profit from, yanking up the selling price at which you sell, known as the ask price, and convincing your clients that your bid price is, so that's the buying price, is, well, that's as high as you can go, because the bigger that spread, the more money you make as somebody who stands in the middle. Now, because of that conflict of interest, some clients who approach or work with broker-dealers specify, how they want their order to be filled, in which mode, broker mode or dealer mode, or instead, to avoid that conflict of interest completely and its consequences, they actually use pure play brokers who act just as agents of the client, who don't have any sort of other way to maximize their profit here. Now, the final type of intermediary are so-called arbitrageurs. It's a difficult one for me to pronounce, arbitrageurs. Okay, you'll probably know these guys because we talk about them in different sections of the curriculum. These are players in the market who look for opportunities to buy and sell either identical or very similar instruments. For example, securities like bonds and shares, at different prices, and critically, in different markets. Now, there are many ways in which you can, explore this. I just showed you that banks, like Goldman Sachs, operate their own sort of alternative trading systems, MTFs, where you can buy and sell shares, just like you can on an exchange. So an arbitrageur would be somebody who would spot that, for example, on the Goldman Sachs market, it's possible to buy a certain quantity of, let's say, Deutsche Bank shares for a price that's lower than the price at which they would be able to sell those same shares maybe on the Frankfurt Stock Exchange, and by doing a very quick transaction, buy where it's low, sell where it's high, in those two different markets, they are able to make a quick profit. Obviously, it's a question of speed here, and it's very difficult these days because, when lots of people have access, or lots of players have access to information, instantaneous information, it becomes a war of speed, right? Whoever gets there first is able to get the profit, and those profit opportunities are very rare to find. But arbitrageurs are nevertheless considered in your curriculum as intermediaries. Why? Because in a way, when you think about them, they bridge and they connect buyers and sellers ultimately in different markets, trading in the same thing, like Deutsche Bank shares. Buyers and sellers who are present in different markets. Okay. And your book then kind of discusses how dealers and arbitrageurs are different, and I want to note this down because it's perfect material for potentially a theoretical question, where you kind of need to appreciate the concept. Dealers connect buyers and sellers. And so do arbitrageurs. They also connect buyers, and sellers. But in the case of dealers, it's buyers and sellers who arrive in the same market, but at different points in time. I mean, think about something like the currency exchange office, right? I'm sure you've used one, especially when you travel. You go to a window and you want to exchange some currency for another, and you do it at an exchange rate which depends on whether you're buying or selling. And at that point, the other side, the dealer, sells you some currency, and you have to pay a price. And but they also buy it from others, but slightly later when it's there, and when they arrive at the window, and they make money on the spread, but it's from by trading with clients who arrive at different points in time. And that's an example of how a dealer operates. On the other hand, an arbitrageur connects buyers and sellers, but in different markets. However, it's instantaneous at the same time. And that's the difference. What is the same? What is different in both definitions? And both are considered to provide liquidity. Both of them provide liquidity in the market. So both are important, although your book says it's quite rare to find sort of pure play dealers or pure play arbitrageurs. They sort of there is no distinct line between them these days. And let's just say that arbitrageurs, let's finish off with this, although your book does have a whole page on this, right? Arbitrageurs often trade based on somewhat more complicated strategies than buying and selling exactly the same thing, because the opportunities to make a profit on that are very rare these days. They often trade, so buy and sell instruments which are in fact not identical, but which are closely related. And the example given in your book is a derivatives example. And if you've already studied derivatives, you will appreciate this. The fact that we can build replication strategies. We've got lots of lessons within derivatives on this, on the concept of replication, where you can use options plus a position in the underlying instrument, for example, shares, combined with borrowing or lending of cash to do the replication. And sometimes you can spot inefficiencies in pricing, and you can synthetically replicate a position using derivatives and get a riskless profit out of it. That's also done by arbitrageurs, but it's a bit more complicated than just buying and selling the same stock.